Hello.
Good morning, everyone. So, Sanam Solati, Yurczyk with New England Prestige Realty.
And Kelly Turner with Total Mortgage.
And today, because we're near the holiday season,
Yes.
what are we going to talk about?
We're talking about a little bit of like the do's and don'ts of the holiday shop. It's funny, I was actually just reading an article yesterday about how this year in 2022, people have actually the highest volume of credit they've had in a lot of years. So what does that mean? More people are charging things, they're using loans, they're using other, home equity lines of credit, other people's money. Now, some of it I still think is a bit of a holdover from 2020 and 2021, where lending was very cheap.
Yeah.
So borrowing, people got in the habit of that.
No, it's not though.
It's not as cheap to borrow other people's money, but people I think are still of it. Yeah. So what can you do to make sure that your holiday spending habits are not impacting your purchasing ability for 2023?
Yes. So basically, with anything in life, right? Live and work within your means, actually under your means. Right? So when you qualify people, you look at their ratios, right? The front and back ratios. Do you want to talk about what that means?
Sure. Yeah. So one of the qualifying factors in a mortgage is called your debt to income. And debt to income is a monthly calculation of how much money you have coming in every month. So your income. Now people, it's more complicated than it sounds, because it's not necessarily just what do you make. It's, do you get bonuses? Do you get commission? Do you get stipends, overtime? We calculate all of those out a little bit differently, but generally, what money do you have coming in every month?
The consistent money.
Yeah, the consistent money. Then the debt piece of it is, what are your obligated debts? What do we mean by that? So mortgage companies are not looking at things like your cell phone bill, your cable bill, your car insurance. We are looking at debt that you have essentially signed a note that you will repay. So credit cards, car loans, equity lines of credit, student loans, that's a big one. Anything that is reporting on credit is what we're going to look at. Now, why is that important? Well, we're looking at not at your balance. Okay, we're looking at your minimum monthly payments. So the more money that you are spending on credit cards, as those balance goes up, those minimum monthly requirements go up. And that's really what we're using to calculate this number.
Like for easy numbers, and I'm just going to use like silly numbers, but like if I'm making just like $100,000, like what would I not want my total debt to look like?
So the goal would be for your total debt to be under 40%. Now you can qualify above that, okay?
But to be comfortable.
To be comfortable, under 40% is generally like a number that you hear a lot, or your housing number should be under 30%. So 30% of your monthly allocation goes to housing, 10% goes to other, your Netflix account, all of the other
childcare, which is literally a mortgage in and of itself.
Yeah, we're not looking at all of that. But those debt obligations are sometimes the tricky part, because people don't always think about them as a cumulative, right? So we look at them as part of what I do is I sit there and add these numbers up for people. And hey, you're making $5,000 a month and you're paying $1,500 in monthly debt obligations that aren't housing. That are, car payments and things like that. Now, car payments are one of the reasons why monthly debt obligations are higher right now than ever before. Because if you have bought a car in the last few years, you know that the price to own a car has gone up significantly. Now we see them in the $500 to $800 a month range. If you're buying a luxury vehicle, you might be paying $1,000 a month on that vehicle, because it's a $100,000 vehicle and it's a house. But we have to take all of that into consideration. Now, what can you do to help, right? So that's the big question we get is like, okay, well, I have these numbers. How do I reduce them?
Yeah.
So the easiest way to reduce your debt is to eliminate obligations, not to lower them. It's to eliminate them.
But I have a question for you. So if you eliminate them, doesn't that possibly impact your credit?
So we're not closing accounts.
Okay.
So closing accounts can impact your credit. What you want to do is say you have 5 credit cards, okay? And most credit cards, the minimum monthly payment is somewhere between $25 and $40, depending on the card. So even if you only owe $40 on the card, your minimum payment is still going to be $25. So eliminating that card completely, so paying it off, not closing it, will reduce your debt obligation. If you took that, say you had $500 on that card
Mhm.
and you had 10,000 on another card. People will often take that, they'll pay the $40 towards our card and they'll put the rest of the money towards the big one. That generally actually doesn't help your debt to income as much because you're just reducing that monthly payment. And if you have $10,000 on a card, your monthly payment may be $300, you're going to reduce it to $220.
Yeah.
It's just not big.
But really, credit cards are not meant to be like long-term loans.
Correct.
They've always had outrageous interest rates. Like people are complaining about 6.5% interest rates for a home, but they have no problem paying 20-25% on a credit card.
Correct.
Like that doesn't even make any sense to me.
Correct.
So really what we want to do is focus on paying off your debt. So use your credit card on a regular. They're great for points.
Yep.
But pay your whatever you've charged up for the month in full if you can. And if not, just knock it away or don't spend as much until you kind of catch up.
Yeah, at 100%. And again, paying off cards and leaving them paid off and then redistributing that money to the next card is generally the fastest way to lower your debt obligations.
Yeah.
It's called snowballing. You can Google it, debt snowballing. It is a tactic, and it's where, like, if you have 5 cards, you line them up from largest balance to smallest. And instead of paying the largest balance off first, you're actually going to pay the smallest. And you're going to pay minimums to everything else, eliminate that debt, roll that money into the next one, pay that one off debt, and you're going to do it that way.
Which sounds counterintuitive.
Correct. It does.
Yeah.
Well, people often try to do it by interest rate.
Yes.
Like, I'm going to pay off the most expensive interest rate. And that makes sense if you are lump sum paying off debt. So say you come into an inheritance and it's $100,000 and you're going to pay off debts. You're going to do it by interest rate because you're going to be eliminating debts in full. But when you're sort of chipping away at it, it can be a little bit trickier to do that. The other place that we do see people able to eliminate debt is often in car payments as well. So you can refinance car loans. And a lot of people don't know that you can do that.
I actually didn't know that.
Yep. You can refinance car loans. So if you took out a car loan, like maybe through a dealership, you might be able to go to your credit union or your bank and get a lower interest rate. And that can lower the monthly payment as well.
Interesting.
So
Very
it's an option.
nice. Yeah. Similar to like the credit cards. If you have like 20% interest and you get one of those 0% interest for 6 months, it makes sense to switch everything over.
Yeah. But
And
only if you're going to pay it off.
Only if you're going to pay it off
in the
otherwise
0%
it'll
interest.
choke you later.
Yeah, in the 0% interest.
Yeah. But like, so this holiday season, while you're out there using your credit cards for gifts, you don't need to overextend yourself, right? Like your loved ones realize and recognize that, you care about them and you want to get them gifts, but not if it's going to put you in a worse position than you are in today, right?
Absolutely. The other thing too is while you're out shopping for gifts, store cards are very enticing.
Who has ever gotten out of a shop without saying, would you like to open up a credit card today?
Yeah, and I love the ones that tell you you'd save $200. Kohl's always gets me. I don't recommend that you do that. Okay. Don't close cards you already have. All right. That's credit tip 101. If you have cards, leave them open. They help with credit longevity, but do not open new store cards. You're just adding debt obligation. And the other thing that I tend to find happens is when we find like stuff in collections, especially on good borrowers' credit, a lot of times it is those store cards that they signed up for. They forget, the thing comes in the mail.
So this was a borrower that I had years ago. I think I've mentioned this on one of our episodes, but my client was getting ready to close on the property. And all of a sudden, the lender pulls credit. Again, I don't know how far before the closing, and finds out that there is something negative, really negative. There was a $25 Macy's credit card bill that had like somehow come up from the time they initially pulled credit.
Went to collections.
Yes. And it messed up his interest rate, messed up, or like it delayed things. It was just crazy for $25.
For $25.
It was so sad.
And that happens with those store cards during the holidays because you take it out, you're in the moment, the bill comes, you don't open it because you think it's junk mail. You think it's a solicitation. You throw it out, they send you a couple more, you still don't open them. Oh, I don't have this card, because you forget that you did it. And then now it's sitting on collections. And we actually see that a lot.
Yeah. That's kind of crazy.
So the moral of the story, be conservative,
very conservative
during the holidays,
and nobody will judge you.
Yeah. And that will help make you prepared for home purchasing in 2023.
For this upcoming spring. And we look forward to helping you.
Yes, absolutely.
Thank you guys for watching.
Thank you.
We'll see you soon.